Last night, we went off the tape with Avant, a privately held company that's the second largest player in the online lending space. Tonight, we're drilling deeper with LendingClub, LC, for you home gamers, the world's largest peer-to-peer online lending marketplace, and the only one that's publicly traded. Don't worry, we'll explain peer-to-peer. Now, LendingClub came public with a bang back December 11th, stock opening up 65% from the IPO price of $15. At the time, considering that enormous spike, I did express some doubts. I said I wasn't totally on board with the company's business model. With the stock down nearly 20% since its first day of trading, those doubts could have saved you some real pain. However, after the recent decline, I got to circle back. Maybe this thing's getting real interesting. LendingClub is a lot like a mortgage originator, except they do everything online. The company collects origination fees on loans that are funded by third parties and then collects earnings fees for servicing those loans. But LendingClub doesn't actually assume any credit risk. Their loans are made with money drawn from various investors who we know are eager for this online lending exposure. I want you to hear both sides of this story. So let's take a closer look with Renaud Laplanche, the founder and CEO of LendingClub, who's with us tonight to explain how his company works and give us a sense of its prospects. Mr. Laplanche, welcome to Mad Money.
Right.
Good to see you, sir. Have a seat.
Good to see you.
All right. I said that I expressed some doubt. I said, what are the real barriers to entry? How do they actually know who they're giving a loan to? Why couldn't you scam them? Why don't you tell me about why those worries haven't proven correct and are not going to prove correct?
Yeah, well, I mean, started by explaining a little bit what we do. I
Sure.
mean, we're a marketplace for credit. So instead of a marketplace with buyers and sellers, we have borrowers and investors. Borrowers are looking for credit, for affordable credit.
Right.
And investors are interested in putting money to work and earning the yield and taking credit risk on the loans. And LendingClub underwrites, prices, and services the loans. So going into your question about fraud or credit risk,
right.
We do a lot of verifications. So when borrowers apply to us, we put a credit report, which is the same thing the banks are doing. We verify income, we verify employment. We connect to a number of data sources that really help us get a good sense of the risk that that particular borrower, that particular loan represents for investors. And then we grade the loans, and we make all that information available publicly to investors so that they can decide to invest in any particular loan or any particular portfolio of loans.
Okay, well, I'm a big believer in Wells Fargo. My charitable trust has a position. I'd like to think they're fabulous lenders. Do you think that you can do a better job than Wells Fargo?
So I think we have sort of state-of-the-art underwriting capabilities, but I think where we have an advantage over Wells Fargo is in our ability to operate at a lower cost. I think if Wells Fargo were getting started today, they would probably go at it differently than they did over 100 years ago. And so we operate in a way that's fully online. We have no branch network. So we have a lower operating cost than the banks. And we just pass on these cost savings to both borrowers, who get lower interest rate, and investors who get better returns.
Well, I saw this addressable market that you have in your notes. People who have credit card debt. These are natural people to go to LendingClub, right?
That's right. Yeah. So we like to help people pay off an existing credit card debt and refinance at a lower interest rate. So credit cards are very convenient payment mechanisms, but they're terrible credit instruments. When you charge a credit card, if you carry the balance to the next month, you'd be paying 17 or 18% interest rate. We can refinance these balances at an average interest rate of 12% for a 3-year term loan at a fixed rate, which is a more responsible way to manage credit. Fixed rate, amortizing loan, equal monthly payments.
Now, you have a deal with Alibaba. Is that publicity stunt, or is there really something to that?
Yeah, no, it's a really interesting combination of LendingClub and Alibaba. So Alibaba is trying to remove friction in commerce, and we're trying to remove friction from credit and lending. So it's really an alliance between two sort of technology-enabled firms. And that specific deal was about LendingClub financing small business, US-based small businesses buying goods from China and reselling them in the US. So we can finance that inventory and match the business cash flow and really sort of help them do commerce.
All right, well, let me ask you a couple devil's advocate questions. One, if it's so good, why hasn't Blackstone done it? And two, if it's so good, why hasn't Amazon done it?
Well, I think when you invent something new, by definition, nobody's done it before.
Right.
I think we've proven over the last few years that the model is working. We have enabled $7.6 billion in loans since inception, and we said we would enable at least another $7.6 billion just this year. So we've been growing 100% year over year. We've showed that we can operate at a lower cost than the traditional banks and deliver a better experience. So certainly there will be competitors and other companies trying to replicate what we do, but we've had a very proactive partnership strategy. So instead of inviting Amazon to do what we do, we would invite them to partner with us.
Okay, and we had this whole experience with robo-lending and people not really being involved. How do you be sure you don't devolve into one of those bad actors that got us in trouble in 2007?
Yeah, so the transparency that comes from the marketplace approach is really important to hold us accountable. I mean, you said it, we don't have, it's not our own money, it's our investors' money.
Right.
And that means we have as much skin in the game as Fidelity or Vanguard or anybody who has investors they respond to. And if investors are not happy with their returns, they're going to go elsewhere. So it's really important for us to continue to do a good job underwriting and servicing loans and making all the data available to investors and having full transparency on the numbers and on the returns and the performance.
Right. And to be fair, just so you know, when you go through the documents, it's very clear your credit. You've been fabulous, frankly. I mean, you've had much better record than almost all the banks that I deal with. So you do have a good business, and I'm glad I caught you at this level for the stock because it's doing quite well. The company's doing better than the stock now. Okay, that's Renaud Laplanche. He's the CEO of LendingClub. A lot of my questions were answered. You should go do the work, too. There's 2 good presentations. The most recent one in March, excellent to understand. Mad Money's back after the break. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.